All right, so why Forex over the stock market? For those of you that don't know, Forex stands for foreign exchange, which is currencies. It's like the US dollar and the Japanese yen, or the euro and the Aussie dollar. All right, so this topic comes up quite a bit when I talk with people, because I always kind of promote Forex market, and people always wonder why this over the stock market, and this is my reasoning. So for me, basically, it just comes down to returns. The potential is just so much better. So let me explain why in a little bit more detail. So in order to trade professionally, you need to act and trade professionally. You need to be smart about things. You need to use your head. One of those things is not gambling and going all in on black, right? This is trading. This is not gambling. These are very educated, calculated trades. Proper risk management is the absolute number one, most critical, most required aspect of your trading, period. If you're not trading with risk management, not trading with stops, and you're not applying these techniques to your trading, you're gambling and you're going to lose your money. So risk management. Capital preservation is a very important aspect of risk management, and this little breakdown here kind of explains why. So basically, if you have 1% drawdown, you lose 101. 5%, 5.26. 15%, now you're up to 17.4. 25, now things are getting interesting. So now you have 25% drawdown, but you've actually lost 33%. It takes 33% return to get back to square one. That's like, okay, you have a $100,000 account, you have a 25% drawdown. Now you have a really good run, you make 33.3%, now you're back to $100,000. You're not profitable, that's just getting you back to square one. Look, this is where things get real scary. Look at 50. Think about this. You've got a $100,000 account, you lose 50% of it in drawdown. That takes you to what? $50,000. You need 100% to get back to $100,000 to square one. Look, it accelerates. 75%, 300%. Let's not even talk about that one. This is why capital preservation is so important. This is why, if you do some research, you'll see that most traders only risk 1%. Never risk more than 1% on any single trade. Okay, so let me show you in practice here. This is a really tiny little $3,000 account. So you can see, this is my entry right here. This is my stop. So if you don't know what a stop is, basically you just say at this price. If the current price, meaning this is where we're currently at, if that goes up and touches this price up here, then just take me out of the trade. I was wrong on my analysis and just take me out for my 1%. So that would be $30 I would lose on this one account. If it goes the other direction, you can let it run forever and you can make 10, 20, 30, 100 million %. It doesn't matter. It can go unlimited. You can also set a take profit, which works exactly the same way as a stop loss. And it's just as soon as the price hits that, it just takes you out and you're in the green. That's the only difference. So right now you can see the current price is roughly down about the same distance as it is the stop right here. So that's roughly about 1% because this is what I'm risking. So you can see here, 30%. I'm almost exactly at 1%. Okay, so now that's 1%. Like I said a second ago, if it goes up, I can lose $30. For me to get that same kind of reward in the stock market, I need to take that $30. Remember, using proper risk management here. Take that $30, put that into something like Microsoft or a penny stock. You're probably better off with at that price range, anyways. Anyways, you put that into Microsoft. You have to get a 100% return just to get that $30 that I just got off this little thing. It took me a little over 2 days to get this 1%. Yeah, it's been ranging. It's kind of been going sideways. But 2 days, I just made 100% in the stock market. For me, that's pretty clear. I don't see how you can really do the same thing in the stock market. Yes, you can trade it leveraged. You can do a lot of things like that. It's just not the same. It doesn't behave the same way. It gets much more complicated, and it's more driven by fundamentals than technicals, which the stock market is heavily driven by. So for me, it's all about the currency market. It's just amazing. Everything about it just rocks. So that's kind of my theory on why I prefer the currencies and over the stock market. Cryptos kind of apply the same way, right? So since we're talking about risk management, a lot of the guys out there trading cryptos have zero trading experience. They're just like, all right, I've got $5,000 cash. I'm going to throw this in. I've got $50,000 cash. I'm going to buy a bunch of Ethereum and hope it goes up. Yep, it might go up and you might make a lot of money, but it can also go down and you can lose a lot. So there's a lot of ignorance in that industry, in that market, excuse me, and it's really scary. So what you really want to do is, if you are trading cryptos, apply the same risk management. Take 1% of your account and buy Ethereum or buy Bitcoin or Zcash or whatever. That's all you can put into it. That's 1%. If your account's really small, maybe 2%, but stick to the 1%. You're better off. It's a lot safer, and you'll do better in the long run. A few more things to keep in mind about the difference in markets is that the stock market is volume-based. There's a finite amount of shares available for a company, so that basically leads to really easy market manipulation. I'm sure you guys, anybody listening to this has heard of the term pump and dump. It's really easy to do, and it happens all the time, and that really only happens in the stock market. Forex market, on the other hand, is so much bigger. It's like the daily volume is like 2 trillion versus the New York Stock Exchange is like 51 billion or something per day, and Forex is like 2 trillion or something like that. So it's really, really big. It's really liquid. It's really fast. It's really easy to get in and out of trades. So that's another thing. When you are trading the stock market, you have to wait for somebody to fill your order. That's like the volume, right? So if you're trading a really small company and you want to buy many shares, a lot of times, or even just a few shares, sometimes it's really hard. You have to wait for it to fill it, and sometimes it never happens. So it's slow, it's cumbersome, it's easily manipulatable. Forex market is super fast. As soon as you click buy, it's like boom, you're in. As soon as you sell, you're out. Those are basically, that money is straight into your account at that point. You don't have to wait for it to get cleared or anything like that. A lot of times there's delays in the stock market. So those are just some of the reasons. Also fees. So if you trade stock market, a lot of brokers will. You can do like Robinhood and that's free, but most brokers like E-Trade and all those, they'll charge a commission per trade. So they'll charge you like $6, $7, $12, $10, $12 or something per trade. So you buy some stock, it's like $12. You sell, it's more money. Currencies, on the other hand, all you pay is the spread. So there's a difference from the buy and the sell price, which right now you're only looking at one, but if I could toggle on this website between buy and sell, you would see there's a small difference. And actually, if I open up a order here, create new order, 2.5, this is the spread right here. So 2.3, and this will change constantly. So basically this is it right here. So it's the difference between 2.1 to 2.4. Or sorry, 0.21 to 0.24, so that's their pip right there. So it's 2.5 pips spread. And what that means is, basically, as soon as you get into your trade, that's how much you're down. You don't really pay a fee, it just puts you down whatever that spread is, and the spreads are usually fairly small. So the amount of money you pay on that is how big your lot size is. Your lot size is how big of a trade you're making, right? So you can see this one right here, my lot size is $6,864. That determines how much per pip you either make or lose. So if it's 2.5 pips, let's just say you make $2 per pip or $5 per pip. If it's 2.5 pips, then that's like 10, $12.50, right? But you don't actually pay that money. it just puts you down. It just puts you in the negative 2.5. So as long as you account for that spread, no big deal. It's basically like trading for free. So it's, you know, like I got in right here, basically, or sorry, I probably got in really right around there, and then it put me in the hole. No, sorry, down here, and it put me up here. So then it goes down. Now I'm on the green. It doesn't even matter what that costs. So that's basically the fees on Forex. Another cool thing about the Forex market is you can trade pretty much all day, every day during the week. Weekends are closed, but Monday through Friday you can trade all day if you want. You can't do that with the stock exchange because it closes at 5 o'clock Eastern Standard Time. Anyways, that's my theory on why Forex over the stock market. Leave me a comment.